Thank you for giving up your sunny afternoon to join us at this webinar, which, as you can see, is all about making the most of your property investments. I'm joined today by a partner here at Davis Grant, Neil Driver, our resident property expert, who's going to take you through the presentation, which will last about 45 minutes today. Thank you, Neil. And if we just go over to the next slide, I just want to give a couple of housekeeping points before we get going. We're going to be using the Q&A button today for any questions that you might have, and we have allowed time at the end of the presentation today to take any questions. So please do use that, and we will try and answer as many of those live as we can before we finish today. We are also recording this webinar, so if you need to recap on any of the points that Neil makes during the presentation, we will have an on-demand version available on the website tomorrow morning. If you do need to leave the meeting, don't worry, you can click leave and just rejoin using your original link. Okay, so at this point, I'm going to hand over to Neil. I'll be back at the end to help Neil field your questions. But at this point, over to you, please, Neil.
Thank you very much, Jo, and welcome everybody. So today I'm going to be talking about aspects of tax and property, because this year there's been a lot of changes going on to various aspects that affect landlords and property and tax. And the points we're going to be touching on are things including the new energy efficiency rules that are coming in. Now, some of these points I'm talking about are coming in the future, and some are going to hit very soon. So really this is about as much about making you aware of what's going on so you can plan for the future rather than how you calculate tax on property, but that is some of it. We're also going to look at additional local licensing schemes, talk about some tax rules on purchasing and holding property, a new overseas owners register that has just come in, obviously applicable if you are an overseas owner. And we'll go through the ongoing Hmrc crackdown on investment property. So like with all webinars, some of it you would have come across before, but I do hope that you'll get a few golden nuggets out of this, and it will be of value for you. So first thing I want to go through are energy efficiency rules. Now, we should all know that all landlords need to have an EPC certificate on residential property. That's nothing new. But what is new is the change in level of certificate that is required. I think currently it's band D, and from 2026, which is a few years out yet, the requirement is that all new lets need to be on band C. Existing lets have got a few years later, they're pushed out to 2028. Now, of course, this is going to end up with more cost to landlords and property owners, because EPC certificates are all to do with energy efficiency. And whilst with what's gone on with energy prices at the moment, and energy efficiency is probably more in play now than ever before, there's a cost to increasing the energy efficiency of a property, and that is going to have to be met by the landlord. The consultation was out with the revenue and various people as to possibly putting a cap on how much landlords should be paying. It's been suggested it's 10,000. I've really got no idea how that would work in practice. What if you had to spend 20,000 to reach a band C? So does that mean you're allowed to be halfway between D and C? I don't know how that would work through. But the point here is that if you are thinking of refurbishing anything, or you are doing work on a property, or thinking of buying somewhere, I think it's important to have this in mind because of the changing regulations going forward, and additional costs that are going to be effectively imposed on landlords. So just wanted to give you a heads up with that one. This relates to probably boilers, windows, roofing, wall insulation and things like that. And then you're also getting into areas to do with, well, how is that allowable when you come to look at your rental accounts at the end of the year? How much of that can we set off against revenue to reduce your profit in the year? And how much of that has to be allocated against capital as a capital improvement? Now, that isn't always straightforward. You then get into areas of what can be deemed to be a replacement, what is new, what's an enhancement. And so it's not necessarily the case that if you were spending, for example, the £10,000 on enhancing the property to get a better EPC, that all of it would be allowable against your income in that year. So there's a lot of planning that needs to be going on around this. Okay. Oops. So sorry about that, just went one slide too far. Additional local licensing schemes. Now, licensing schemes are in place, kind of mandatory, if you like, for HMOs, multiple occupancy houses. But some of you might have come across more arbitrary local licensing schemes. Now, these are schemes imposed on residential landlords to obtain a license for a property. And these are in local authorities, area by area. The little graphic here shows where they have been in the UK a few years ago, and also in London. This is probably a little bit out of date. I couldn't find something kind of COVID times onward. But it shows where they are, and this is an increasing cost that's coming through. There are reasons why councils can impose an additional license, even if it's not an HMO, usually around if there's bad, if there's poor housing conditions, or maybe migration into the area, or deprivation or crime. ASBOs was what I was looking for before. And those are reasons why licenses can be imposed. They can be quite expensive, £300 to £1,000 per property. But I think, being cynical, this is an ever-increasing area for local authorities to generate more income from. And with the way everything's going, it's likely that they're going to have more and more local licenses. So just a heads up as to what's happening in that area. Now, rules on affecting purchasing and holding of property. So tax rules change significantly as time goes on. And in 2022, there's a lot of changes coming through. There's new CGT deadlines. We've got a change to business rates relief, which mainly relates to second or holiday homes. We've got changes in mixed multiple dwellings relief, and we've got others as well. So on the capital gains tax, it's for the last couple of years, capital gains tax has been payable on residential property almost as soon as that property is sold. It no longer is allowed to go onto a tax return or and paid when the tax for that year is payable. This year, they've extended the deadline from 30 days to 60 days. But what that means is that within 60 days of completion, a capital gains tax return, separate capital gains tax return with a full computation, needs to be submitted to Hmrc, and at the same time the capital gains tax has to be paid. No longer is it possible to save onto that tax for quite some time. If it was a personal disposal, you have to pay that. So this isn't anything new for those of you that are active, but it is something that is in place still, and it just will go. I'm just looking for something came through on the news today that there is an error message coming up when some of these returns are being put in. and that error message seems to be associated with the way an address is put into the return, not matching through with another part of the database. And the error message that comes back is, we can't process this at the moment, please come back later. But you come back later, and if you're putting the details in exactly the same way, you're going to get the same message. So if you or you know someone that is doing that and has got an error message, please recheck how you're entering the address, because that's may well be where the issue is. So these rules mean that you have to work out the capital gain immediately, and from a practical point of view, that means you need to accumulate all the information about the acquisition costs. Again, in the past, those could be dealt with later in the year when tax returns or accounts were done. But now you need to be thinking about what, sometimes finding the cost of a property and all the enhancement costs and the legals and everything of when you bought it could be buried in files somewhere. So so that you're not caught out near the 60-day deadline. If you are thinking of selling something, at the same time, make sure you dig out all the purchase information and any enhancement capital expenditure you've had along the way. What is capital gains tax due on? So really, other than individuals' main residence, you generally have to pay capital gains tax on all properties. And those include let properties, second homes or holiday homes, and homes that have got significant grounds or gardens. So, a country estate that has got many acres. I'll be talking about those in a minute, where the acreage is more than a certain amount, an acre or so, then the extra land is not deemed to be part of the house. It's deemed to be not part of the exemption that relates to the main residence. So that could be taxable in certain circumstances. And this is another new thing. Non-residents must also, even if you're non-UK resident, have got to report the sales or disposals of UK property, all UK property. The previous returns I was talking about was just about residential property with a 60-day return, but all property for non-UK residents within 60 days. And that is the case even if there's no tax to pay or they've made a loss, which is quite unusual for the UK, because UK is usually based on notification of a tax point. That's what tends to trigger something. But the environment is that the government wanting to clamp down on what they see to be tax evasion, tax avoidance, and that's more likely where you have foreign ownership of the property. I'm going to come on and talk about a new register to do with foreign owners towards the end. Business rates relief. Now, this is really to do with second home owners and holiday homes. And it used to be possible to classify a holiday home as for business purposes for rates if that home was available to rent for more than 140 days a year. So in the past, it didn't actually have to be rented out in order to qualify, but you merely had to put it with an agent or put it on a website. And if it wasn't rented out, it didn't really matter because it was all about availability to rent. But now the rules are changing, and it's now changing to having to prove the property has been rented out for at least 70 days a year. So it's not even talking about availability, it's talking about proof that it has been rented. And if it hasn't been rented out for 70 days a year, then you're going to be forced to be paying probably council tax instead of business rates. And that's a big change for second home owners. It depends on where it is. Here we've said £1,000 a year, but it depends on the size of the property. And it depends upon where you are in the country. But that is closing of a loophole. And also to do with empty properties. In the Queen's speech this year, the government said they were going to give more powers in general to local authorities to charge higher rates on empty properties than they had in the past. That hasn't been legislated on yet, but it is something that is in play, so to speak. And as I said before, with a cynical hat on, it is another way of generating income that wasn't previously around. Mixed properties is an interesting case. SDLT, stamp duty, is chargeable on different rates for residential property and non-residential property, quite significant differences. If the property is mixed between residential and commercial, then the current rules say that the SDLT is charged on the entire property using the non-residential rates. Now that can be, it could be more than 10% difference on some elements of the purchase price, and it can be really quite significant. Now, Hmrc is proposing changes to those rules to what they say would create a level playing field, but ultimately will put tax up for some people. Now, this is something that is not enacted, but there is case law and various tribunal hearings that are demonstrating what the revenue are trying to get at. But it would be fair, perhaps, not that it always comes into it, to apportion SDLT at rates between the residential part and the non-residential. That's one option that could be happening. So if a third of the property was commercial and 2/3 was residential, then you pay 2/3, 1/3 on an apportionment. But then you get into arguments about how do you apportion the value between the two. Or it could be that the property is treated as non-residential if the non-residential part exceeds a certain threshold, maybe a half or a third, and that's another possible basis. But we don't know yet what that's going to be. It's just that something for you to look out on and be aware what's around the corner. Another item in the news is multiple dwellings relief. This is, for example, it can be when you're buying more than one property. It is more than when you're buying more than one property or dwelling in a single transaction. And when you do so, when you calculate the amount of SDLT stamp duty that is payable, the way it's worked out is an average consideration for each of the dwellings. I'll just come on to an illustration as to how dramatic that can be in a minute. But obviously it means that the greater the number of dwellings, the lower the stamp duty, because it's just the way the maths works through on the purchase price. But the Hmrc are proposing that this multiple dwellings relief is restricted where dwellings are only for when their dwellings are purchased for a qualifying business use. Now that is still up for debate as to exactly what that means. Or they might limit it to where there's 3 or more dwellings or subsidiary dwellings within a larger dwelling. So say, for example, someone's buying a house with an annex to it. Now, it's argued that the house and the annex are 2 separate dwellings. They could be separately rated, not necessarily, and therefore that will affect and lower the SDLT. Things like granny annexes, or maybe a property that is let separately, and even things like where I was talking before about mixed use of properties, where it reduced the stamp duty from from residential to non-residential, it was things like where someone was renting out a garage on a business basis, or they were claiming part of the home was used for business purposes. Those were arguments that were being put forward for that. But with multiple dwellings relief, again, as an example, it could be a granny annex that brings down the value. So they're looking quite closely at this too. Registration of overseas entities is a completely new bit of legislation that came in just this month on the 1st of August. And this only applies if an overseas entity owns a property or land in the UK. It could be an individual, but they're now required to declare a lot of information about the beneficial owner to Hmrc. Now, beneficial ownership goes further than just, say, if you had a BVI, if you had an offshore company that was owning the UK property, it's not the offshore company that needs to give details, it's the underlying owners who need to register. So it's quite onerous, and they need to provide information on a specific register, and that register needs to be maintained and updated, similar to companies' house records for limited companies, because this is also going to be a publicly available register at Companies House. Information is going to have to be certified before it goes on, and they're really quite serious about knowing who the ultimate owner is if the owner isn't in the UK. And this is going to apply to freeholds and leaseholds originally granted for over 7 years. So it's not a particularly long leasehold at all. And it's effective now. So anybody that is in the process of wanting to buy or sell, like a new transaction, they're going to have to register. And then once you're registered, you can get a particular number, and then you can put the details on. For property held since 1st of January 1999, the register needs to be completed by the 31st of January next year. So still a good few months further for that. I think in Scotland, the date goes back 10 or 15 years before then, because of devolved governments having different things that they can effect. But that process has to be done. This is another bit of compliance that needs to be done before that date. The kind of information that's going to have to be required is, as I said, about the beneficial owners rather than just the holding entity. And it's talking about people with significant control. Significant control is something that's come in for limited companies. There is a register of persons with significant control over the entity. This is almost the same wording that you use when you look at Companies House and you look at who owns the company or who controls the company, then they're applying the same rules across now to property, which comes down to, in broad terms, 25% or more of the ownership or voting rights in relation to whoever owns the property, the right to appoint the majority of the board on a company, and this information has to be updated annually. So it's just a bit more horrible compliance, and everybody gets an ID before you can register. This is, hold on, went too far again. The seriousness of what the government is saying about this is really on fines and imprisonment, daily fines of up to £2,500 for being late, and imprisonment for up to 5 years. The rules are complex, and there is time to do something about it. Although it's quite new, we are up to date and know how to help people. So as with anything, please contact us if this applies to you. Now, I just wanted to refresh about HMRC's what they call Let Property campaign. This is really about disclosing property income that hasn't been disclosed before. And I came across a very interesting point. Our offices are, of course, in Ilford, on the borders of Essex in London. And I don't think they quite publicise their claim to fame that there's the highest number of landlords with undisclosed property income in the Ilford area. And the top 5 hotspots were dotted around London and the southeast. I'm not so surprised about the hotspots. I suppose I should say that I'm surprised about Ilford, but that's just the way it is. Those just are the facts. I just thought it was interesting. So what is the Let Property campaign? It's a special campaign that's been running for quite some time, where the Inland Revenue reduced down the amount of fines they charge not getting a tax return right. And it is quite beneficial to disclose property income that hasn't been put on tax returns before. Using that way, you can reduce the fines from 100% down to about 20% or less sometimes. Unfortunately, it's not a level playing field, and negotiating with the revenue can have mixed results. Sometimes they can be far more understanding than others, and when you're trying to appeal in grey areas of what the legislation will allow, different people are interpreting things in different ways. Again, with my cynical hat on, I think it's going to get harder and harder to get anything out of the revenue, because the country isn't particularly sound financially, and I wouldn't be surprised if they dig their heels in even more. And that being the case, if anybody has got undisclosed property income, should really use this scheme. It's open to all residential property landlords for all kinds of rents, individual properties, multiple properties, really any kind of letting. And it includes renting out a room in your home for more than the rent a room threshold. It's about £7,000 a year, but the way rentals are going, it is possible that someone might think, oh, I'm just letting out a room and it's tax-free, but when it goes above the threshold, it then becomes taxable. So all those disclosures should be made under this scheme. There's special rules that apply to people who live abroad or intend to live abroad. But even those that live abroad, there is still UK tax payable on UK property income. So a non-resident still has to pay UK tax on UK let income because it's generated in the UK. An individual will still get their personal allowance against it, even though they're not living here. But if someone, has lived in the UK all their life, decides to go and live elsewhere, but retain their old home and rent it out, that income needs to go on a UK tax return, and they need to pay full tax on it as anybody else would, even though they're not in the UK. To take part in the Let Property campaign, there's a special process of telling the revenue that you want to be in it. You register on there, and then whilst the registration is going through, you get together all the details about the tax that is due to pay, make the relevant calculations year on year, and sometimes this can go back a long time. There is really goes many years that it can go back to when the rental started, and so it can be difficult to find those details. Not everybody's got interest statements or repairs or knows what's gone on in years gone by, but we're used to dealing with situations like that, and we can guide you through it. Then those details are put into the revenue and the tax calculated, and then the formalities are made. you settle up with them with what you owe. And it is possible to make payment plans for most taxes at the moment. That's one positive that's come out of COVID, is that the revenue are very soft on allowing all kinds of payment plans for all kinds of taxes. So now is the time to do that in general. And even though interest rates are rising, it isn't a punitive interest rate that they apply to effectively borrow from them. And the more you help the revenue, the better it is, as with most things. So I've been through this. This is just basically saying what the process is, but in principle, it's best to let us run the process for you, and once it's through, you then include the details on your tax returns as normal. If you are catching up, you can say, well, why can't I just submit a self-assessment tax return for the previous years? But the reasons that you can't do that are that only as we stand now, the current tax year is open, the 21-22 tax year is open, and 2021 tax year is open. Any years before that are blocked for doing self-assessment tax returns in the normal course of events, so you can't put in a tax return for those years. And also, if you were to go that route, the fines and penalties, and the it's not just interest, it's the surcharges that they add onto late payment of self-assessment tax will undoubtedly be higher than the fines and the surcharges they're going to charge if you use the disclosure process, because under the self-assessment you get interest which is the same across the board, but there's a 5% surcharge every 6 months on unpaid tax past 31st of January after the end of the tax year. So that's the reason not to put it on tax returns and use the disclosure process. I've beaten my slides, so I just explaining before a bit about interest and penalties, and those really can be really onerous and need managing as much as possible to do with the tax that you're going to be payable on an inquiry. It can double up the tax, then you've got interest on top, and it can be really quite nasty. So use the disclosure thing. I think that is all I wanted to go through today in terms of content. I will open up the floor now to see if there's any questions. If you have any that you'd like to ask, please do put them in the question and answer box, and I'll get to them. But I'll ask Joe if there's anything that's come through.
That was great. Thanks very much, Neil. Yeah, we've got a couple of questions here, so we'll try and get to these if we can. First one, is CGT on the sale of a shop the same as it is for a buy-to-let property? Okay.
Well, there is capital gains tax payable, and they're calculated in the same way, but you've got a difference in the amount and the percentage of tax that is worked out. A shop would be a commercial rate of 20%, whereas the residential property is generally at 28%. The rates are lower if you're an individual and you are not, and you're only a basic rate taxpayer. That could be 10% or 18%. So they are different, and it's cheaper with a commercial property than a residential property.
Okay, thank you. Hopefully that's answered that question. I've got another one here. I've got a few buy-to-let properties. Should they be in my name or a limited company?
Okay, that's quite a good question, and one that we hear quite a bit. And the answer to that one is really an accountant's answer of it depends. And it depends on a lot of factors. It depends upon what you intend to do with that portfolio. If you're going to grow that portfolio, then quite possibly a limited company is the better vehicle. And it depends upon where the capital that you're investing in comes from, if it's in your own hands or if you're going to be withdrawing it from a business to put the deposits down. And it, it can bring in lots of things to do with inheritance tax planning, and so on. So it's a complex thing. Generally, because of the way interest relief against the rental income is going, there is a general trend towards having more limited companies than in the past. Problem with that is that the finance sector and the loans are not equal. You tend to find that the interest rate for loans in a limited company are greater than those in individual hands, and that can be a driver as to the return that's made and so on. So it's quite a common thing. It is possible, if someone's got a portfolio of several properties, to change the ownership structure from individual hands into a limited company. And there's advantages on that because it can shield the ongoing income from high rates of tax. And that is a process that we can take people through. And there are loopholes to go through and processes to go through that can look at mitigating the capital gains tax and stamp duty that would arise if someone put their portfolio from their own names into a limited company. So yeah, a bit of a round the houses answer to that question, Joe, but it isn't a straightforward yes/no answer to it. It is one that depends upon quite a bit and would need a good discussion around that.
No, understand, fair enough. I think we've got time for one more. So I've got a question here about disclosure to Hmrc. So does the disclosure to Hmrc for missed rental income apply to overseas properties as well? Oh,
that's a good one. It does, but it's different. Technically, the disclosure scheme I was talking about relates to income on UK properties, and that reduces down, as I said, the penalties quite significantly. The disclosure that relates to overseas properties is made under a different disclosure process, and the penalties are not reduced anywhere near as much. They can stay at about 100% of the tax due. So, say for example, you originally lived abroad, and the person came into the UK for a job, kind of the reverse of what I was talking about during the presentation, and they got a normal PAYE job in the UK, paying their tax as they go along, but they're renting out their old home, or they might have even had a small buy-to-let portfolio in their original country, or anywhere in the world actually. Because the UK, you have to do a UK tax return, and when you're a UK tax resident, you're taxed in the UK for your worldwide income. Doesn't matter where you were domiciled, doesn't matter where you came from. If you're resident in the UK for tax, like you're here working full time and you've got a job, then you are liable for UK tax on your worldwide income, and that would include properties from abroad. And if that is the case, and you forget to put it on your tax return, technically you're not eligible for the landlord scheme I was talking about, and it's this very similar process of disclosing and disclosing under a scheme, but you're under more something like a Liechtenstein scheme for capital assets rather than a rental one. Very similar process, but you will not get the reduction of the penalties, and that's the issue. Now, we have in the past a mixed bag of experience with that. We've had knowledge of, I'm not sure if I'm allowed to say that we've done it, but of individuals with foreign property who've gone through this process and they have accepted it this way. We've had others that have been picked up and said, no, that's foreign property, this doesn't apply, and they will levy the full penalties. So that's the answer to that one, Joe.
Okay, right. I think we've just about run out of time, Neil. So I'm going to finish it there. Just wanted to say thank you for the presentation. That was great. Obviously, if anybody has got any questions they'd like to ask, then just drop us a line at info@davisgrant.co.uk. Visit the website. You'll be able to get in touch with Neil directly from the website. And we'd be happy to help. As I said, we're recording, so an on-demand version will be available on the website tomorrow if you do need to recap on any of the points made. So thanks, Neil, and look forward to the next one.
Thank you too, Joe. Thanks everybody for listening.